Hey, Paul here, and in this video we're going to discuss a trustee's duty to account to the beneficiaries of a trust. I'm Paul Rabalais, I'm an estate planning attorney, and beneficiaries of a trust, they often want to make sure that the trustee is acting appropriately. So how do they do that? Well, maybe the best way to explain it is to give you an example, kind of a broad example. Let's say dad is 60 years old with 3 kids. He has an estate worth, let's say, $2 million. Dad is now married to, let's call her new wife, who's not the mother of his 3 children. And dad sets up his revocable living trust. And of course, he's the trustee and he does whatever he wants to with it while he's alive. But dad wants to keep his new wife and kids from having to go through probate together when he dies. So he sets up his revocable trust to avoid all the probate, and then dad's revocable trust says that when dad dies, dad's revocable trust becomes irrevocable at the moment that dad dies. And in dad's revocable trust, he named new wife as the successor trustee to be in charge of the trust after dad dies. And it's customary for dad to name new wife as the income beneficiary of that trust. Customary for dad to name his 3 children as the principal beneficiaries of that trust. And it's also customary for dad to say that the trustee, after dad dies, the trustee has the discretion to use principal for the income beneficiaries' health, education, maintenance, and support. All right, so that's a mouthful. You may need to go back and rewind it and to get all the facts and get it all straight, but all those scenarios are fairly common. So what are the trustees' accounting obligations and requirements? All right, so let's look at the situation while dad is alive. Dad has a revocable trust that says when he dies, new wife is the trustee and the income beneficiary, and kids are the principal beneficiaries. Well, under our Louisiana trust code, which is where I'm a lawyer and where I practice as an estate planning attorney, and you'll have to check with your own state trust law. But our trust code in the trustee accounting provision says if the trust is revocable, the trustee has a duty to account to the settlor only. So what that means is, and dad is the settlor of his revocable trust. So the only person that dad needs to account to is himself. The reason that provision is there is if, for example, dad set up a revocable trust and did something that was not customary, he named someone else as the trustee of his revocable trust, then that someone else who was the trustee would be accountable to dad. So that's the deal with the accounting provisions while dad's trust is revocable. Now, when dad dies and the trust becomes irrevocable and new wife is the trustee, a completely different set of rules here. And I'm going to read, there's 3 sentences I picked out that I think are most relevant here as we talk about a trustee's duty to account. So the first thing I'm going to say is a trustee is under a duty to a beneficiary to keep and render clear and accurate accounts of the administration of the trust. So, after dad dies, new wife has to keep and render clear and accurate accounts of the administration of the trust. So dad had $2 million. Let's assume some of that after dad dies is investments, maybe some of it's some property or real estate. So new wife there has to keep and render clear and accurate accounts. Okay, now we get into really what new wife's duty is. Because you know what the kids are thinking? Dad's kids are thinking, wow, we don't really get these assets till new wife dies. New wife is in control of all of the money. She gets all of the income that the trust assets produce, and she can use the principal for her health, education, maintenance, and support. We ain't going to get nothing when new wife dies because she's going to abuse her power and she's going to drain the trust. That's what the 3 kids are thinking. So they're like, what can we do to hold new wife's feet to the fire now that dad has died and she's in control of this trust? So that's where these trustee accounting provisions become relevant. And so another provision in our trust code says a trustee shall render to a beneficiary or his legal representative at least once a year a clear and accurate account covering his administration for the preceding year. I'm going to go ahead and read one more sentence and then we'll talk about it. Each annual account shall show in detail all receipts and disbursements of cash and all receipts and deliveries of other trust property during the year, and shall set forth a list of all items of trust property at the end of the year. Okay, so now those kids every year can say, hey, new wife, I know you're the trustee of Dad's trust. We're the principal beneficiaries. You got to show us every year, show us, what income the trust generated, show us any receipts that the trust took in, any disbursements that you made out of the trust. If you made some disbursements out of that trust for your health, education, maintenance, or support, we want to see what those are and we want to know why you did it. And also we want to see a detailed listing of all of the trust assets as of the end of the year. So the kids have the right to ask for that because that's what's required under our trust accounting provisions on trustee being held accountable to the beneficiaries for those income and expense and trust property items. So, whether the new wife delivers the accounting is another thing. Whether the kids sign off on it, if she does deliver it, it's another thing. New wife is probably not going to be sophisticated enough to provide the accounting under the accounting rules. So new wife is probably going to have to engage the services of some accountant or some third party to help her, supply the necessary accounting items. So that's where it's, kind of shaky sometimes when a, surviving spouse who may not be real sophisticated in business and accounting has these accounting obligations to the principal beneficiaries of the trust. And so all that's going to probably cause some animosity between Dad's 3 children and the 3 children's stepmother, who was Dad's new wife. Okay, so all that is just a piece of what should show you that the designation of a trustee of a trust is really important. This one probably turned into a mess and sour relationships, and so if it did, what perhaps could Dad have done differently to avoid that? Well, it's tough. Maybe Dad could have named one of his children as the trustee. Maybe Dad could have named co-trustees, maybe new wife and one of his children as co-trustees. Maybe Dad could have named a corporate trustee with $2 million in Dad's estate to go, in Dad's trust to go for the benefit of new wife and kids after Dad dies. That's probably enough to justify the fees that a corporate trustee would charge to serve as trustee. So those are some options. Another thing Dad could have done was watch this video and punch the like button, and then also subscribe and hit the notification bell so that he would find out even more estate planning information so that he could make good decisions for himself and his family in the future. So probably you could learn from Dad as well, and also punch the like button and the subscribe button and the notification bell so that the YouTube algorithms will put my videos in front of you more often. All right, so that's the deal there. The trustee accounting, the designation of trustee. Often these decisions are made very, very quickly. They have consequences. Be aware of them. Make informed decisions. We'll see you next time.